Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now, don't forget to subscribe to our YouTube channel for the latest on the markets and, of course, the economy. Now, the Federal Reserve recently wrapped up its latest meeting, keeping interest rates steady between 5.25% and 5.5%. Now, this marks a cautious stance in the environment where inflation, though on a downtrend, is still above the desired 2% target that the Fed keeps talking about. Now, the economy is showing signs of solid growth with strong consumer demand and improved supply chains. However, high interest rates are affecting business investments, particularly small businesses. And it's also an election year, making these economic decisions even more critical. Now, the Fed's dot plot suggests potential rate cuts later this year, yet for now, rates remain steady. Let's hear what Fed Chair Powell had to say.
We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks.
Economic uncertainty, of course, we've heard this before. There's a lot to unpack today, and of course, David Rosenberg, Chief Economist and Strategist at Rosenberg Research Associates, joins us to break it all down. David, thanks again for coming on.
Pleasure's mine.
I appreciate your time here because we spoke last December and you mentioned that a lot of this economic data is not really the reality on Main Street, at least not for normal consumers. You know, markets are staying quite resilient here after Jerome Powell's press conference. I'm curious about your thoughts here, longer for higher, the potential. Anything surprise you from this latest Fed announcement and meeting?
Well, nothing surprised me too much. I mean, they weren't going to do anything with rates, and they hardly changed the press statement. They left the dot plots basically intact for this year. They took one of the rate cuts pledged for next year out of the forecast, but who knows what 2025 is going to look like. I think that, why the markets rallied so hard and, all the major averages hitting new highs, and gold and silver, the dollar coming under downward pressure, the 2-year note yield sunk 7 basis points, is because I think there was this residual concern that he might sound hawkish at the podium. Now, I didn't find he was overly dovish, but the concern was, after two relatively hot CPI numbers, January, February, that he was going to sound more concerned. The reality is that he didn't sound too concerned. He called him a bump in the road, and that his view was that the disinflation trajectory is still intact. Not 100% sure, but that's still his base case view. And I think it was that sort of tone that the first couple of months of the year are not upsetting the apple cart that risk-on investors took a lot of comfort in.
Yeah, he talked a little bit about this seasonability too, where some of this data might be seasonal. How should investors interpret the Fed's dot plot against things like the GDP growth and consumer spending here?
Well, what's interesting is that we just had, back-to-back declines in real retail sales. And in fact, retail sales volumes, and of course that's 40% of the consumer spending pie. It's not the whole thing, but it's very cyclical, and that is starting to contract. So the consumer demand is actually starting to falter. We'll see if a few months is a trend, but that's the data. So far in the first quarter, I thought what was interesting was when explaining, the upward revision to the GDP forecast from 1.4 to 2.1 for this year, he put in the framework of improved supply dynamics, not so much that it was demand. And a lot of that coming from, this information that coming to the fore that helps explain the, 3% plus growth last year that these undocumented immigrants coming in waves have had a skewing impact on the growth data. So again, I think that's something that the markets took well, that here you have the central bank chairman really talking more about supply side dynamics influencing those GDP numbers as opposed to being fueled by demand. Because if it was fueled by demand, then I think the inflation prognosis would be quite a bit different than what he portrayed today, which I thought was reasonable. The key again is that, he has still a view that inflation is going to be coming down. He told us repeatedly the Fed does not have to wait to the 2% target to start taking the thumb off the economy's Adam's apple. But the view that that this is supply side led, and of course we know we're getting a productivity boost the past several quarters, that's inherently disinflationary. So he sort of downplayed the inflationary impulse from that, unexpected increase in their GDP forecast for this year.
Yeah, it's interesting because, as you mentioned, there is a little bit of a debt crisis. Consumer delinquencies are rising too. Jerome Powell talks about the two-sided risks of doing too little or too much here. Let's take a listen to what he had to say.
That's always the question we're asking ourselves. And we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy. And we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery. And so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Yeah, it's interesting. I mean, we go back to December when he kind of appeared to pivot a little bit and come back to today where the economy is seeming resilient. Explain to the audience a little bit about these dual risks. What's at risk here, and is the Fed going too slow?
Well, we'll only know in the course of time as to whether or the extent to which the Fed has already over-tightened and already stayed too tight for too long. I think that we have to cut Powell and his colleagues a little bit of slack. They never saw 9% inflation, although it happened for 1 month in the summer of 2022. And they were wed to the view that it was going to be transitory. And, we had an inflation episode that lasted almost 2 years. So it's a case of once burned, twice shy. And they certainly don't want to make the same mistake twice. And he made the point that inflation is a tax on the poor and the elderly, and it creates all sorts of distortions, but it hits the most vulnerable parts of society. So, he's not going to wait for the whites of the eyes of inflation to get to the 2% target. He's not that dogmatic. He just wants to make sure that this trajectory, bumps notwithstanding, is going to be fully intact. I guess that the answer is that yes, I think he's willing to roll the dice and take more risk with the economy because he didn't sound like he'd be in any rush to raise interest rates. And remember that right now the policy rate is pretty well exactly where it was, maybe a little higher than it was in the summer of 2007. And, we all know what happened in the next 6 to 12 months. So he doesn't want to destroy the economy. He doesn't want to create the condition where they ease policy prematurely. If you're going to ask me where I'm leaning more that the risk is that they're going to wait too long, and maybe they've already waited too long, because we still have the lags of what the Fed's already done. Those lags can sometimes take 2 to 3 years. So remember, the Fed started raising rates in the summer of 2004. Then they stopped tightening in the summer of 2006 under Bernanke. And then look what happened next. Look how those lags took hold, and they don't happen overnight. And then last year, the interest rate impact on the economy got clogged up because we had these powerful antidotes from dramatic fiscal expansion and the credit card boom and the last leg of the excess savings in the personal sector being totally unwound. These are non-recurring factors in 2024. So my sense is that I understand what he's saying. He's trying to be balanced. My sense is that, especially because inflation is such a lagging indicator, and my concern for a while now is that we have a Fed that is so scared of its own shadow that it's not even willing to react to its own forecasts. It's reacting to lagged and contemporaneous economic indicators. So I think there's going to come a day when they're going to have to cut rates much more quickly. And I think the longer they wait now, the more they'll have to do down the road.
There seems to be a little bit of a divergence here upon consumers and then, of course, business investment. The Fed's report noting a slowdown in business fixed investment due to, of course, higher interest rates. But I'm curious, is there a different scenario playing out? I mean, businesses seem to be fairly squeezed here.
Well, especially the small business sector, and this came out loud and clear in the February NFIB Small Business Index, that expansion plans and intentions to boost investment has declined precipitously. And of course, everybody's saying, well, look at this generative AI wave that we're seeing right now. But, that's not the overwhelming share of the economy. And it's not something small businesses right now are spending a lot of money on. I think that the one thing that's happening that every business knows is that the clock has run out in terms of the refinancing calendar, that, a lot of these businesses locked in and now the bill's coming due. And so starting this year, and then it escalates in the next 2 years, we have an unprecedented wave of corporate debt maturities coming to the fore. And so what companies are doing, of course, as they want to stay in business, is that they're keeping a lot of that retained earnings on their balance sheet to serve their debt service in coming quarters. So that money's not going to capital spending. Capital spending has basically been flat over the past year. And I'll tell you, because, offline we were talking about how easy financial conditions are. And you look at the debt cost of capital in the corporate sector and the equity cost of capital, and financial conditions could scarcely be easier. And yet, the old question, where's the beef?
Right.
Tremendously easy financial conditions, the equity debt cost of capital ordinarily would be triggering a capital spending boom, but that's not happening. And that's partly because companies are now keeping cash on hand to service what they know is going to be a wall of refinancings over the next couple of years.
Yeah, no, I haven't seen the price of capital being this high in a very long time. I'm curious how careful Jerome Powell has to be here, and the Fed, to remain unpolitical. I mean, as much as they want to, there is an election year happening this year, and whether it's May, whether it's June, this could positively benefit one of the candidates. How are they reacting to this? Well,
the thing is that when you go back, and this is what I do for fun when I'm on the tarmac in particular, is you read the transcripts from the Fed meetings from decades past. And I've looked at the ones that happened during election years, and they do talk about the election, but it never factors into their decisions. I mean, they're obviously aware of it. They read the newspapers, they watch television media, but it doesn't really ever influence their decisions, and nor will it this time around either. But, will there be political ramifications? That more depends, I think, if Donald Trump gets elected, because he's already talking about, who he'd want to run the Fed. And we all know that he criticized Powell incessantly, back in 2018. And so I'd say that it's interesting as to what I think is going to happen, because it's getting apparent in the data. It wasn't apparent in the Fed's forecast today. They trimmed their unemployment rate forecast. They raised their GDP forecast. It all seems like a very rosy Goldilocks scenario. But the data I'm looking at are telling me that cracks are emerging. By the way, emerging in the labor market and emerging in the consumer spending market. And consumer spending is 70% of GDP. And then we have all the lags to consider. And there's no offset this year. I can't see what the other catalysts are going to be to offset the lags from the damage the Fed has already done. So by the time the summer rolls around and the Fed hasn't cut rates yet, and then of course they'll be scrambling, but everything the Fed does this year, let's say they start to cut rates this year, it doesn't show up in the economy this year. Everything they do this year will show up next year and the year after, because the lags, you measure those in years, not days, weeks, or months. So I think this puts, Biden's chances, not that they're that good anyways for other issues like, his foreign policy and the border issue. But I think that by the summer and fall, the recession is going to come into fuller view. So you'll be saying to me, well, he's cutting rates. That should help the political side on the Democrats. And I'm going to say, no, sorry, it's too late. It's too late. So everything that they're going to be doing and they're not doing anything now, and probably not in May. But once they start cutting rates, it's going to be too late. It's no different than when they started cutting rates in 2007. If we had an election in 2007, which we didn't, what would that have meant? Oh, he's cutting rates. That's going to help the incumbent get in. No, look what happened heading into the next year. And that's my primary concern for the next 12 months is that we're going to see those lags kick in more forcefully.
And do you think we'll see those lags come and those cracks starting to steep in a little bit more forcefully Q1 of 2025?
Well, I think that there's a good chance that it will. You see, I am still in the recession camp. Maybe I'm the last recession, the last economist that hasn't thrown in the towel. I almost chuckle when I hear people say, well, the recession didn't happen last year, so it's not going to happen at all. It's like me saying from my perch in Toronto, it didn't snow in December, so winter's been called off. People were saying the same thing in 2000. Recession began in 01. People said the same thing in 07. Where's this recession? They pulled the plug on their call. Then it started in 08. And so I think that when I talk about the cracks, I mean, I think you mentioned a couple of them. Look at what's happening on credit card delinquency rates and auto loan delinquency rates. Now, it's true. It's not about the mortgage market or housing market this time. That was last cycle. Lightning doesn't typically strike twice. But you're seeing wide swaths of the consumer space feeling the strain. You've got delinquency rates now, serious delinquency rates, 90 days past due, at their highest level since 2012 when the unemployment rate was 8%. I mean, delinquency rates are behaving as though we have an unemployment rate that's double today's level. Imagine what happens when the unemployment rate really starts to go up and impairs wages, and then you start getting another leg up in these late payment rates. And then that feeds on itself in terms of what it means for tightening in the banking system. So I'm starting to see these things, that the credit quality in the consumer space is deteriorating. I'm noticing in the retail sales data, and not just the retail sales data, but keep in mind that in each of the past 4 months, the retail sales data that everybody is gawking over, the retail sales numbers have been revised down each of the past 4 months. Right. And downward revisions tend to feed on themselves. So I'm starting to see, I mean, we talked about, flat business investment, but it's the consumer that drives the economy. And yes, the consumer has been hot for a variety of reasons, but I think the temperature is starting to change this quarter. It's just not generally accepted yet by the marketplace, or by the Fed. But I'm getting a sense that maybe not at the next meeting. Of course, we're not going to get a new set of projections, but by June, a lot of these changes that were made today to the forecasts are going to be looking stale.
Okay, interesting, because we were talking a little bit about that 2% rate, that inflation target that the Fed's trying to get to. Here's what Jerome Powell had to say about what's needed for rate cuts.
That the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
David, his second point is interesting here, and it's quite dovish. Is he admitting that inflation no longer needs to be at 2% for a cut if labor declines significantly?
Well, he's very consistent on this point that the Fed is targeting 2% ... over time. And he says over time and again. So, and he's said repeatedly that the Fed is not going to wait to 2% to start cutting rates. It's not as if, the starting point of the funds rate is like 2 or 3%. It's, 5.25 to 5.5. And they're already starting at a point where they're almost 300 basis points above their own estimate, their new estimate of neutral. So, I think that the first rounds, maybe the first 100, 150 basis points of rate cuts, I wouldn't even classify as easing. I would classify it more as taking away the excessive monetary restraint. So that's why he doesn't have to see the whites of the eyes of inflation getting to 2%. He just has to be convinced that this trajectory, which has been in place for the past year, is fully intact. And I think that if we didn't have these CPI readings and, of course, the PC deflator, they wouldn't have cut rates today, but they might have been signaling one for May. But the reality is that they had 2 months of not so good inflation data. They're hoping, and their base case is that it was a seasonal bump in the road, and I agree with that. But if we had had a couple of months of 0.1s on, say, headline and core CPI, we'd be looking at the rate cuts probably starting, before the summertime. But, that didn't happen. And they just want to, they don't have to be 100% confident. They just want to have a high level of confidence before they make that move. And they know how the markets are going to react, because as soon as they make the first rate cut, then it's going to be, the brokers will be pricing in, a whole easing cycle. Look what happened in December. They just sneak in one extra dot for this year, and everybody's talking about 6 rate cuts. So I think that they're sensitive to the market reaction as well.
Yeah, it seems like they're sensitive, but Powell had the opportunity to address the equity markets. It's been on a run. The S&P's at a new high. As you mentioned, we got all-time highs for gold and Bitcoin. Some big wide spreads here. He didn't address any of that. Should we be taking anything from that, or is this just more of a hush, muted kind of sentiment from Powell?
It's a great question, because I've been talking about for many, many months that, are they sitting around the mahogany table and just thinking about, how's it possible, 500 basis points later, and the shrinkage in the balance sheet that, the punch bowl is still sitting at the bar counter. But you're right. Quite often it's what you don't say that's as powerful as what you do say. This is not Alan Greenspan. Alan Greenspan was a markets guy. Alan Greenspan came out in 1996 and famously talked about irrational exuberance. But then again, Alan Greenspan was a real market player. And Jay Powell doesn't often talk about it. He might the odd time talk about financial conditions. However, if he were to talk about the fact that all these things, stock market here and bond market there and credit spreads here, then somebody will come back and ask, well, okay, if you're so concerned about financial conditions, why aren't these financial conditions generating an economic boom? The most bullish prognosticator is just talking about a soft landing, which is modest growth. And even I think that's probably too optimistic right now. So it's telling us that it's not a concern. I guess maybe,
history doesn't matter anymore, I guess.
This might, well, he could come out and say, the stock market's ripping and the treasury market's contained and credits, all these markets are doing what they're doing. And maybe it's the markets are giving me a vote of confidence over Fed policy. That maybe if inflation was a problem, so look what happened. We had a bear market in 2022 when inflation was ripping. So the stock market was probably telling the Fed, you are off the mark. You are so far behind the curve. So the Fed, he could come out and just say, hey, look, the stock market is booming, and it's telling us that we're actually doing a good job on policy. But the fact he doesn't bring it up means it's not a concern to him. He's just laser focused really on the economy, the labor market, and inflation expectations. And I suppose he just doesn't want to muddy things up and add more confusion by adding financial markets into that equation.
Yeah, and more questions from people like us. David Rosenberg, I appreciate your time today. I know you're super busy on Fed Day, so thanks for making the time and helping us make sense of all of this today.
Okay, all the best. Thanks for having me on.
Thank you, sir. And thank you, of course, to the viewers for watching. Don't forget to subscribe to our YouTube channel and like this video. We'll have more to come. I'm Jeremy Szafron, and this is Kitco News. We'll see you next time.